Robschild. No investment advice. Welcome to the show where we view financial markets through technical analysis, macro financial history, Benjamin Graham's investment philosophy, and of course, crystal ball gazing. Today is Wednesday, September 18th, 2024. Today's episode will start by stating that history has been made today. The federal decision of doing a 50 basis point cut today is huge. It's the first cut in 4 years, the first cut of this cycle, and it's twice as big as a normal, everything's okay kind of cut, suggesting that, the Fed is basically admitting, in my eye, that they should have cut their first cut last month. When the Fed starts with a 50 basis point cut, it indicates they have fear. Another important piece to this is called the dot plot. This is what the rest of each one of these dots represents an anonymous vote of members of the Fed and where they see interest rates being in this year, next year, and the following year, and in the longer run. Notably, in June, you can see the lighter colored dots are where the dot plot was in June, and the darker dots are where the information was just released today. And as you can see, for the year of 2024, the Fed, the members of the Fed were not expecting as many cuts for the rest of the year. And then this month, they flipped to suggest they are anticipating 2 more 25 basis point cuts. And then in 2025, we went from, most people in the Fed looking around a 4% Fed funds rate target, all the way down to as low as maybe 3.25. Now, while the dot plot is suggesting a target rate of 4.4%, the Fed funds futures rates actually disagree with this. As you can see from investing.com, Fed funds futures is now pricing a target of between 4 and 4.25%. That's with almost 50% chance, and there's even a 14% chance of even a further cut, while there's only about 38% chance of it being where the Fed dot plot is believing that they're going to be. And, I find this fascinating that we're so close to the end of the year and the Fed funds futures rate is directly disagreeing with this dot plot we have. One of the reasons I use investing.com for my source to see the Fed funds futures rates is because this isn't the first time I've seen the CME Group website basically broken. Currently, as it stands, and I see most people use this website as their primary resource. It makes me wonder how many AI algorithms are using this information and seeing what I see here. This is completely incorrect information. It says that the November meeting, we have a 67.7% chance of a 25 basis point hike instead of a cut. This is incorrect. This is simply incorrect. These numbers up here didn't get adjusted. Someone is messing this website up. It drives me a little crazy because so many people rely on this tool. It should be working, and it's broken. Again, this is why I check the CME Group and investing.com daily. On to the daily reminders. The 2-year, 10-year Treasury yield curve was inverted for over 2 years, reverting on September 6th, suggesting that we may be headed into an extremely bad recession or depression, since this never happens. The last time this happened was right before the Great Depression. The Somme Rule was also triggered in July of 2024, suggesting the recession has indeed already started. This indicator says that unemployment has been rising at an unsustainable pace. The S&P 500 is sitting at a PE of 29 without major earnings contraction, also while bond yields remain arguably elevated, suggesting that the S&P 500 stocks are very overvalued right now, with all of these indicators saying that bad things are coming. And not only that, the cutting cycle has finally begun. When the cutting cycle begins, this very frequently is when we go straight into the recession and the economic slowdown. And so with all of this together, I don't even know if it requires a crystal ball at this point, but my crystal ball reading is a market crash is coming, and that I believe that the Fed will not cut fast enough to save the economy. Again, monetary policy is less effective than people expect it to be when we have fiscal dominance, when the U.S. has so much debt. On to some charts. We'll start with the S&P 500, the SPX. This is a daily chart. Most of my charts, by the way, are obviously daily charts. Each bar represents one day. So during today, we opened kind of flat. We went up on the initial news of the cut because the way I look at it, dumb money is saying, ooh, money's cheaper to borrow, therefore equity valuations can go up. And while that's partly true, the fact that we're starting this cutting cycle and all of these other signals saying that we're headed straight into a slowdown suggest that, cutting is not exactly good news right now. And so, the bulls have lost. The bulls have lost. If we were going to see a market rally from this point, it would have started today. It would have made sense to start today. Today, it was the cut. All the news is out. It's done. It's over. I mean, we still have to wait to see how Asian markets and European markets react to this news. What they do, the way they trade, the decisions that their central banks make based on what our central bank is doing. Things can get wishy-washy here. But the way that I see it, the bulls have lost. The bears took hold of this and drove the market down into being, again, not a massive day down, but again, like, cheaper cost of borrowing money is good news, and we go down in the stock market. This is it for me. I think the top is in. And on an intraday basis, that happened actually in the middle of the day today. Very similar action going on in the Qs, or the NASDAQ, poking our head above this recent trend line and closing not just below the trend line, but below yesterday's close. This head and shoulders looking top, I believe, is still in play, and I believe this will contribute to momentum downwards in U.S. equity markets. Now that the September VIX futures term structure contract is off the table, we only have the October contract in here, making the VIX futures term structure curve look extremely wild. Again, it's supposed to be low on the left side and higher when you go further to the right because time costs money. But October is now elevated above, all the way out above through, let's see here, past March. Wow. So the market is expecting increased volatility through October, as I am myself. I currently still have, I talked about it on a few shows ago, I own puts on SPY, I own puts on HYG because I believe that credit spreads are really tight here. And if this, it doesn't take much for credit spreads to spread. If treasury yields go up, it puts further pressure on the cost of borrowing money, especially for lower credit companies. At this point in the cycle, it's just, I love being in that position. If you've been following the show, it's been going against me so far. I don't think it will last. Again, anything can happen here. All I can really do is take a look at the technicals, take a look at, again, macro financial history and just try to see everything through the eyes of Benjamin Graham, the way he would interpret everything going on. And I'm comfortable with that. I fully expect markets to get rocky and get very bearish very quickly in the coming weeks. If you've been following my show, you know that I have now it's 56 or 57% of my portfolio in basically TLT, other funds that hold long treasury bonds, ZROZ and TMF mostly. We had a little bit of a break today, but we are still in a bullish pattern. I am still bullish in this market. I still think there's a ways to go for interest rates to drop. This is largely because the market's not pricing in any fear still. And when they do, this should be soaring higher, really. And that hasn't even started yet. So I'm going to have to sit in this until I see some soaring movement. And once rates get to a reasonable rate or things start normalizing, I'll get out and I'll hold cash. Hopefully, my whole longer term plan with what's going on is to be able to get into junk bonds actually when they get at a discount. If you know about security analysis, Benjamin Graham, this is his method. It's his way would be going through the individual bonds and finding them at severe discounts. Luckily today we have people to do that for us with HYG and HYT. There's funds of junk bonds. I don't have to go through and pick like a whole big selection of them at a massive discount. I just buy the fund, and if you look at the history of those charts, it's the best way to play this in my strong estimation. For safety and risk reward, like great returns there. Even if like stocks become very unpopular for a long time, when we get to the bottom of the cycle, it's the junk bonds that will recover, and that's when you can make massive amounts of profits very safely. Of course, some of these bonds go bankrupt, and so you have to time it right, basically. But for now, I sit still in treasury bonds with 56%. Speaking of junk bonds, I would not want to touch them with a 40-foot pole. Again, I've been describing this market as Mr. Market driving down the highway 90 miles an hour with a few drops of gas left in his tank with a water bottle full of something that's not exactly water. When you have your guaranteed yields in treasuries rising, especially at the same time as apparently junk bond yields are dropping, this is just very dry tinder for making money on the downside right now in junk bonds, in my strong estimation. Apparently, an army of Redditors have taken over the CNN business page with the Fear and Greed Index. We did it. We're back to greed. I imagine the next 2 days will show some digestion of all of this information. Again, we need to see how Asia and Europe reacts to this. But all in all, in my estimation, the bulls have lost, and that's all from me and my crystal ball. Hope you enjoyed. Thank you for watching, and see you next time. Robschild.